The 3 ETF portfolio is the simplest and easiest way to make you rich and wealthy over time without the hassle of stock picking or getting rich quick through day trading, but from long-term investing in just 3 ETFs. Now, only 3 ETFs might sound too good to be true. It's a portfolio that I've been doing for the past few years for not only high returns, but even dividends for passive income. Now in this video, I'm going to be going over what even a 3 ETF portfolio is by providing a full in-depth breakdown of each component of the 3 ETF portfolio, which ETFs to choose that are best for each component, how to manage a 3-fund portfolio for yourself, and the returns of my personal 3 ETF portfolio to make you rich and wealthy if you stay the investing course in the long run. Now without further ado, let's get started. The original 3 ETF or 3-fund portfolio was created in the 1990s by investing legend Jack Bogle and his so-called Boglehead followers. The portfolio consisted of 3 different components, one being US stocks, international stocks, and US bonds. This portfolio allowed investors the simplicity to invest and grow their wealth over time without the hassle and worry of stock picking the next Coca-Cola or McDonald's to IPO on Wall Street. However, if you invested $500 per month for 25 years in this old 3-fund portfolio, you would have over $420,000. Now that's a pretty good return, but you are seriously leaving hundreds if not thousands of dollars on the table if you just updated this old 3 ETF portfolio to the new and improved and modernized 3 ETF portfolio that I personally invest in and other great investors do as well. If you invested just $500 per month for 25 years in this new and improved 3-fund portfolio, you would have over $1.1 million. That sounds better, doesn't it? For beginners, an ETF stands for Exchange Traded Fund. Now, what an ETF is, it's basically a basket of different stocks all compiled into one investment. Think of an ETF like a box of 1 dozen donuts from your local bakery. In a box of 1 dozen donuts, you have 12 different individual donuts, each individual donut representing a single stock. But when all 12 different donuts all get compiled inside a single box at checkout, then it goes from a single stock to an ETF. I hope that made sense. Now for a 3-fund portfolio, there's 3 basic principles that everyone should follow. The first is to pick one ETF for each category for simplicity purposes. The second is to always have an investing goal in mind. Like for example, physically go to your mirror and see if you are either a dividend investor, a growth investor, or both, where you value both growth and income in your investing goals. Now the third principle is to stay the course. Try not to sell in and out of positions or stop investing because of a recession and when stocks pull back. It's inevitable because stocks can't just keep on going up and up and up. Eventually they will pull back, but you have to stay the investing course if you want to make long-term wealth. Now the stocks and ETFs I'm going to be talking about in this video are amazing and high quality stocks, and I almost can guarantee that when they pull back, they will eventually recover back to their all-time highs and continue to go up. Now this new and improved 3 ETF portfolio consists of a foundational ETF, or basically the core of your investing 3 ETF portfolio. Now the goal behind a foundational ETF in this category is to have an ETF that you can buy and hold forever if you could only buy one fund. The foundational ETF is used for safety and peace of mind, yet providing healthy and high returns. Now 2 ETFs I believe are going to be amazing for the foundational ETF category is going to be an S&P 500 fund like Vanguard's VOO, or a total stock market fund like Vanguard's VTI. Here are some honorable mention funds that can either replace both VOO or VTI that I've created using M1 Finance. You can find this link in the description of this video, where I created a pie of the best ETFs for this category. Some of you might be asking, well Marcos, why would I even choose an S&P 500 fund or even a total stock market fund for the foundational ETF? Now the S&P 500 has returned high returns of over 10% on average annually since 1957. Literally, you can't go wrong with the S&P 500, which is over 500 of the largest and best performing companies in the world like Apple, Microsoft, Tesla, Coca-Cola, and many more stocks inside of it. Even VTI is great and amazing because it has literally all the stocks in the United States, even the small cap and mid cap companies, so you are technically more diversified. Even after the Great Recession in 2008, and the tech bubble crash in 1999, the S&P 500 continued to go up and up, and even after a pandemic in 2022, you made a ton of money in the S&P 500 or this total stock market fund because of its high returns all throughout history. The next component of a 3 ETF portfolio is to provide both cash flow and safety, or what I like to call it is the dividend ETF category. Now, the old 3 fund portfolio used bonds as this cash flow and safety category because historically bonds kept your money both safe and stable without the risk of investing in stocks, as they offered low returns in exchange for a dividend or interest rate for holding the bond called the yield. The old 3 fund portfolio used BND by Vanguard, which is a total bond market ETF, but the returns are so low of around 1.5% annually over the past 10 years, which is legit like burning your money because you are getting eaten away by inflation. The new replacement to bonds in this new 3 fund portfolio are dividend stocks or dividend ETFs. Because dividend stocks and even dividend ETFs aren't going to be as risky as the S&P 500 because the stocks inside of these funds are going to be growing their cash flows and revenues at a lower rate compared to the growth stocks inside the S&P 500. Because dividend stocks are, in my opinion, boring companies, but with great business models that have been around forever and ever. And they are paying a high dividend yield and payments to investors as a thank you for investing in their company. And the dividends legit grow and grow every year, so you get paid more and more by doing absolutely nothing besides holding the dividend ETF or stock. Now, 3 dividend ETFs I like for this category are going to be SCHD by Charles Schwab, VYM by Vanguard, and DGRO by iShares. Like I said before, you can check the description of this video to find my M1 Finance Pie for alternative funds that I love for this category. 2 ETFs I own in this category are going to be SCHD by Charles Schwab and DGRO by iShares. Now, why I own both is because one is in my Roth IRA and the other is in my taxable brokerage account, because both these accounts have different goals, but more on that later. Now, both these ETFs have great capital appreciation and even a great dividend yield of anywhere from 2 to 3%. So your money literally grows and grows and grows, and your dividend payments will eventually snowball to pay for some high expenses like maybe a mortgage, a car payment, or maybe even a fancy meal. If we put $50,000 into BND, in 10 years that would grow to only $58,000, but if we invested into something like SCHD with its 10-year annual returns, if we invested $50,000 into SCHD, in 10 years we would have almost $150,000 plus a dividend paying us passive income of 3.3% from SCHD, which is a heck of a lot more than just going in on bonds. If we add SCHD into our 3 ETF portfolio, coupled with our foundational ETF of S&P 500 ETF, VOO, then we will have a fund overlap of 8%. If we have a high fund overlap, that's not necessarily a bad thing in my opinion, but it means that we might not be as diversified as we think we are, where a low fund overlap percentage means we are technically more diversified into different asset classes. The old 3 fund portfolio had our last category categorized as international stocks, but what I like to call it is the growth category, where it is going to be high risk and high reward. Back then, it made total sense to diversify into international stocks and funds because the lack of technology made it really hard for businesses to expand and operate. But now with new innovations into technology, US companies like Apple and Microsoft, for example, sell their products and operate on a worldwide global scale. So you can call these stocks global companies or worldwide stocks per se. And an international fund back then was something like Vanguard's VXUS, which provided around 4.5% annual returns on average over the past 10 years. Now, by replacing this international slice with growth ETFs, you can capture the highest performing growth stocks that operate on a global scale. Now, some of the best ETFs for the growth category are going to be, in my opinion, Invesco's QQQM, SCHG by Charles Schwab, and VUG by Vanguard. Here's a snapshot of the fund alternatives that I have in M1 Finance. Like I said, link is in the description. I personally own both SCHG and QQQM into 2 of my 3 ETF portfolios in 2 different investing accounts. With an ETF like SCHG, you are getting returns that are beating the S&P 500 of around 15% per year, Reason why SCHG and growth ETFs are able to yield higher returns is because of their holdings into tech stocks, which are technically growth stocks, where their profits and revenues are growing rapidly year over year, which in return will yield to a higher share price because of this rapid expansion. Now let's put a bow on this 3 ETF portfolio that we've created and that I personally invest in of our foundational ETF of Vanguard's VOO, a dividend fund like SCHD by Charles Schwab, and our growth ETF category of SCHG by Charles Schwab. We're going to use a backtester to compare our new 3 ETF portfolio and the old 3 ETF portfolio of VOO, BND, and VXUS, as well as only investing in the S&P 500 over the past 10 years worth $100,000. Now the new 3 fund portfolio wins by a long shot by providing the highest annual return historically and providing the highest returns compared to only the S&P 500 and even the old 3 fund portfolio. Now I have 2 3 ETF portfolios, one in my Roth IRA, which is more of a growth-based investing style that I love, with the foundational ETF as VOO by Vanguard, the growth ETF of SCHG by Charles Schwab, and the dividend category of DGRO by iShares, with the highest holding being to SCHG because this is a growth investing account. Now my other account with my other 3 ETF portfolio is in my taxable brokerage account, with the foundational ETF being VOO by Vanguard, the dividend ETF being SCHD by Charles Schwab, and the growth ETF being Invesco's QQQM, with the highest holding being to VOO because this portfolio is more of a growth and income investing style. And always dollar cost average or DCA into your ETFs to get the best possible price, because we are long-term investing and not thinking with a short-term mindset, because wealth is going to be built over time and not overnight. So don't care if the prices go up or go down, continue to dollar cost average, which means buy either every day, weekly, monthly, I don't care how often you buy it, but just continue to buy your fund, and I promise over time you will see those great returns and retire with a lot of money. That about wraps up this video, guys, on the best 3 ETF portfolio for long-term investing as my ultimate guide to you guys watching this video. Now, if you guys like this video, please do give it a like because this cute puppy did, and comment down below an ETF or 3 ETF portfolio that you guys are investing in for the long term. Now, if you guys want to check out what watch I'm wearing, what books I recommend, I opened a Amazon affiliate store where you guys can check out my favorite investing books and items that I love and I know that you guys will love as well. Link is in the description of this video. Now, hopefully you guys have a great rest of your day, week, or night. Continue to crush the stock market and take it easy. Peace.